Hey, it's Joe Springer with the Wall Street Exclusive, helping you make informed decisions so you can succeed in the market. I have a great piece of information for you today, and it is this. You should never naked short an individual stock. You should never naked short an individual stock. We'll talk about what naked is at the end, and we're about to see all the awful things about shorting. But first, what is shorting? Shorting is selling a stock that you don't own. Let's say that you don't like AT&T, and let's just say AT&T is at $10 and you think it's going to $5. What you could do is you could borrow, let's say 100 shares from an AT&T shareholder, sell it at $10, wait. If AT&T goes to $5, you buy back those shares, return the 100 shares to the shareholder. You've made it 500 bucks because you sold it for 1,000, bought it back for 500. Hey, you made 500 bucks. The shareholder is, if they were going to keep, if they're a long-term holder for AT&T anyway, they're happy in general because you paid them like 3% a year or 4% a year or something like that to do that. So if they were going to keep the stock anyway, free money for them. Okay, so that's why people would short in the first place. Something to know about shorting. Shorting is not the opposite of going long. It's just plain worse than that. It's sort of the opposite of going leveraged long. When you short something, the most you could ever gain is that first amount you get when you sold it. So that $1,000 in that case, the amount you can lose is unlimited. AT&T could go up to $1,000. You'd have to buy it back for $1,000 a share. You're on the hook for $100,000. That's not very good. So that's the very first thing about naked shorting an individual stock. It has terrible risk characteristics. You will never know what you are risking. And when you short something, the most you can ever gain is 100%. So if the amount you got in the beginning is the most you could ever gain, and then so you're just trying to buy back for as little as possible. But the amount you can lose is unlimited. And so if a short goes against you, it becomes a larger and larger part of your portfolio. And then you got to think about, well, geez, now I better cover this and lock in this awful loss, or let this become a bigger and bigger part of my portfolio until it eats my whole thing. So there's terrible risk characteristics in shorting. That is right there. You should never naked short an individual stock. Number two, there's terrible tax treatment. If you buy a stock and you go long a stock and you hold it for more than a year, you can have a long-term capital gain. Hey, very nice. If you short a stock even for more than a year, it's always a short-term capital gain. So the tax treatment is terrible. Okay, so awful risk characteristics, terrible tax treatment. Number three is historical bullishness in the stock market. The stock market goes up over time, always has. Most stocks are going to, even if it's just because of inflation. So you're betting against inflation there as well when you're shorting. So there's historical bullishness, things are going to go up, and so you're betting against that. Number four is you're sort of tied to the market. What Mohnish Pabrai talked about, he's a legendary investor, is you sort of have a leash to the market because those stocks can blow you out. When you go short, there can be a short squeeze. Volkswagen, the car maker, became the largest company in the world temporarily because everybody shorted them, and then they announced a deal, I think, with Porsche, and then shares went up more than $9,000 per share because everybody was short, and then they announced this deal. Everybody's like, oh my gosh, I better buy these shares back and return them before I have to buy them for a huge amount. And everybody started, it was a short squeeze, and people, no matter how small their shorts were, people lost everything. People were blown out. And so the risk characteristics are awful. And so there's number four is you can never take your eye off it. You have to watch that stock, can't go do research. You have to watch that constantly. Unlike a long, it's like go do work for me, Hershey or something like that. No, you short, you have to watch it. And so number five ties into that. It's time. What people do is, okay, I'll short 40 stocks because I don't want anyone blowing me out. And now you have to put on the time to all 40 stocks, watch them all. And so number five is time, but there's also, you don't need to do that because stocks generally go up anyway. Look at the biggest gainers list every day. There's always stocks going up a lot every single day. There's no reason to do all that to short. There's no big advantage. It's not like you can get something in shorting you can't get somewhere else. So don't blow all your time in that, even if you do have good shorts. Number six is that the best shorts are usually not available, or they're expensive and dangerous with squeezes anyway. So if there's like an ETF that is like doing a bet on leveraged volatility, and even in the prospectus of that ETF it says we expect this ETF in the long run to go to zero, you still are going, for one thing, you're going to have to pay a lot to borrow. Everybody's going to want to borrow that, so you might have to pay like 40% a year or something like that. So you better get it right in the short term, and they can still go against you in the short term. Plus, it's going to be hard to borrow. Plus, if all those people are short and then something happens, there could be a squeeze. So again, you could get killed. Terrible idea. Okay, so shorting is a naked shorting an individual stock is a terrible idea. It doesn't give you any way to make money that you can't get anywhere else. You can make a lot more money going long. Okay, so is there any reason to ever short? I'm thinking of two things here. One is, let's say you have 10, let's say you bought 10 stocks 10 months ago. They're all doing pretty well for you. They're sort of broadly diversified. You've made a nice gain. So the idea is you've got some stocks you've made a nice gain on, but it's been 10 months, you don't get your long-term capital gain yet. Maybe you're worried about a broad market sell-off. So what you could do is you could hold your 10 stocks and you could sell like the S&P 500 short. You could sell the SPY short and hang out for a couple months until your stocks are long-term capital gains. Maybe not such a bad idea. There is, if the market keeps going up or stays flat, then that will probably work pretty well for you. If it goes down, then it won't be that bad because your SPY short should protect you. It's a short-term capital gain there, so you would have been better off probably just selling your stocks in the first place. But still, not too bad. That could be useful. So that's not an individual stock. That's the S&P 500. The S&P 500 is not going to get bought out by Porsche overnight. So that's one reason to consider it on sort of the broad market to protect your individual holdings in lieu of selling your individual holdings. Okay. So that's one. Number two is more interesting. Let's say you're using call options, and let's say with AT&T again. So AT&T, let's say it's at $9 now, and you think it's going over 10. So you buy a call option to buy it at $10. Let's say it costs you 10 cents and it expires in 3 months. So if AT&T goes above $10 in the next 3 months, that call option will have some intrinsic value. And let's say you get it right and AT&T goes to 11. So now your call option is intrinsically worth $1. You have the right to buy it at 10. It trades at 11. So that call option is intrinsically worth $1. What you could do is you could sell that call option and make your 10 times your money. You bought it for 10 cents, sold it for $1. Maybe you sold it for a little more because it still has some time value left as well. But so that's one thing you could do, is just close your trade, take your money and run, and that's fine. But look at this. What you could also do is you could short AT&T. So a call option gives you the right to buy 100 shares of a stock. You could short 100 shares of a stock at that time that you wanted to sell your option. And then that sort of basically flattens you out. So if AT&T goes up 50 more cents, you lose 50 cents on the short, you gain 50 cents on the option, so it flattens out. If AT&T goes down 50 cents, you gain 50 cents on the short, you lose 50 cents on the option, it flattens out. However, what if AT&T goes back to 9? The short keeps making money, but the option stops losing money. So there's a smart thing to do. If you can work that out, where you can get out of a stock of a successful call option play by shorting instead of selling the option, there's a good reason to do that. So in that example, you bought the option for 10 cents, then it became worth $1, and then you shorted instead of selling it. And then when AT&T goes back to $9, the call option is now worth $0, but that short is worth $2. So on your original 10 cents, you've now made 20 times that amount. And you still own that option as well. So now if it goes back, so you could close your short and lock in 20 times your gain, and then wait for that, and you can keep your option as long as there's still time in it. And that option, let's say, goes back to 11, you could do it again. Now that's a lot of good luck needs to happen to do that, but there actually is a reason to short there. But that's not naked shorting. You're covered there. If the stock takes off and you're short, you also have your option, so you're flat. And so that's not naked shorting. And with the S&P 500 example, it wasn't naked shorting an individual stock. So you can naked short the S&P 500, you can short an individual stock, but you should never naked short an individual stock. And in general, you don't need to short. Don't short. Okay? I hope, and one more thing is that shorts serve a purpose. Every time you've bought a stock as a long, you bought it, just regular bought it to have it and have a long position, that stock probably generally traded around where its fair value is, because if it was too undervalued, people would want to come along and buy it. If it was too overvalued, the shorts would want to come along and knock it down. So the shorts do serve a purpose, and as a long, you should be happy that they're there, making things generally fair valued, but let other people take those risks. You don't want to do that. Okay, I'm Joe Springer. I hope you found that very helpful for the Wall Street exclusive, helping you make... All right, I hope you found that very helpful for the... All right, for the Wall Street Exclusive, I'm Joe Springer, helping you make informed decisions so you can succeed in the market.